the previous slide. Okay, second trading range, secondary test as an upthrust action, has price action and volume signature as buying climax. I understand your interpretation is just curious. Yeah, it has those characteristics, but this type of characteristics are not just necessarily going to be present at the buying climax. You can have different other spots that would have expanding spread signature, expanding volume signature. Excuse me. So my logic here was just based on interpretation of the change of character and the stopping action of the buying climax. But if you would put it here, buying climax, as I mentioned before, you could label it in a different way. Yeah, you could probably think that this is phase A right here, and then this is B, and then this is C again, and that would be okay. Again, the labeling does not really matter if you're making a profitable trade. That's the whole purpose of everything that we do here. All right, so what do we have on time? I was kind of thinking that we're going to go into 6 o'clock today, so we still have some time. Okay. All right, so this one was somewhat easy. A lot of you guys just kind of like nailed it everywhere. I like that a lot of you put here phase C right here. Again, we are talking about an attempt to upthrust. And just because it creates a lower high, that's why we label this as a last point of supply and couple of tests into the supply. I'm sorry, into that last point of supply. Major sign of weakness. Look how in the downsloping distributional range, we are seeing a commitment to the downside and then attempt to come back into the trading range, and it comes exactly to the point of the resistance that acted before as the sloping down support. So all of the concepts are there. They're all correct. Okay, well, it is definitely a very interesting Wyckoff story here, but I think that maybe we'll skip this for today. Look at this value zone where we are seeing that a lot of institutional buying has happened in this area. So where is the price? It's right here in the zone. So that defines that institutional value zone for us. Anything below this is oversold and will be quickly bought in by institutions. Look into this, look into this. And we kind of could see how these 3 points are creating a sprint type of action just slightly below that institutional value zone. So that's kind of like a true definition of a sprint to me. It's an oversold condition below an institutional value zone that produces a quick absorption of the available supply below this zone, and that brings the price back into that zone very fast. And that's exactly what we're seeing here. Another interesting thought here is that look at the volume signature. Once institutions are in this position, they just basically don't buy. They consumed, absorbed all of the supply available, and they're just waiting. So as the price retests the lows, every time in the oversold condition, there is some kind of small pickup of the supply, and that absorbs and kind of concludes the absorption process. That absorbs whatever is left to what they already have bought, and they have bought so much that at some point supply is no longer available, and even an inactivity by the CO produces a move up just because supply is so low. So this is a very important point. We will come back to that on other slides. All right, here, okay, guys, I think that what you'll do here is let's just do this on your own. So let's do a self-review. So this slide, okay, so this one is interesting, and a really good question from Nalesh. Let's go first through the distributional weak hands value zone. So we know into the buying climax, the first point of excitement is going to be by weak hands, it's going to be on the climactic run, which is this. So, and we see that from the demand signature, and we define the zone throughout this whole range. Now, the question that was asked by Nalesh is, at what point do we need to consider this as an upward sloping trading range? Because originally, this is what we would be thinking. And originally, that's how I labeled this range when we had this change of character that was well defined with the increase in volume signature and the biggest reaction in this upswing that we have seen. That suggested a non-consolidating environment, a trading range, and the question that Nailesh is asking is very important. At which point would we be thinking about upsloping structure rather than more of the horizontal structure? And I think that we would be thinking here, and I think this was another question from somebody, or maybe in this question we could see this. Would we be biased here? I think that without thinking too deeply about this, and by deep thinking, I would be thinking about what were our original targets. And actually, the original target suggested exactly the stop in action somewhere in this area. And those type of PNF targets were off 2008, 2009 trading range. So that's a big trading range right there. So if we are in the vicinity of these targets, we should be extremely careful, and we should be stopping, listening, watching as to what the price and the volume is showing us and telling us. Having said this, it seems that this area has the texture of the reaccumulation. We see multiple tests on the diminishing volume signature, that the tests that are higher lows, and we have higher highs, local higher highs. So that looks constructive and bullish. This reaction right here that has some volume signature does not produce a big result to the downside. It's diminishing as a result, which is bullish, short-term bullish on such a big effort signature. Also, it stops exactly at the first point of the first automatic reaction. So that's also a good symmetry, bullish symmetry for us to see. So I wouldn't mind actually, having a position or thinking about establishing a position at this spot. So somewhere here on the breakout, that's another possibility. And then once you are in this trading range, you're probably going to close out this position here. This will be your exit. So you guys kind of could see that my strategy is not necessarily to be correct every time. My strategy is to be sure that I'm going to see the opportunity and I'm going to use this opportunity. Obviously, on a much deeper level of thinking, I mentioned the target zone right here, and I mentioned this really briefly. But this was a very consistent sell-in right here that should have produced some kind of hesitation. But the actual recognition of this pattern came right here. And the reason why it came here, in this, on this reaction or on this failure, is because we're still talking about a leadership stock that has a structure of the distributional structure of higher highs, higher lows. And those are going to have a lot of reaccumulation characteristics in phase B. So it's extremely hard to figure this out until it actually shows itself on a change of character out of the trading range. But if you train your eye to recognize this failure, so there is no continuation up, there is a failure, then somewhere here in this zone, you could change your bias. And that's what I do with a lot of stocks. And I've shown you guys with Navadir just recently, where Navadir has been such a leadership stock. I've tried to short Apple in this campaign to the downside and kind of like picked up just, was correct on the bias, was, too premature to exit. But the concepts are the same. Leadership stocks are going to be distributed in a different way, and you have to sometimes change your bias on the change of character after a new high. And sometimes it's extremely difficult to do just because mentally it's hard to do. Now look what happens with the weak hands value zone as the price falls and comes into the oversold condition. First of all, the recovery is very quick. That suggests that still there is some kind of value to some of the weak hands at this point of time. And then look at the second rally. It comes exactly to the point of where weak hands were starting buying. It excites buyers because they are thinking that this is an oversold condition. And then institutions are just selling into that excitement. Both of the rallies have that excitement characteristics behind it, and in the way how the price moved. And then on the way down, we're seeing that late institutional capitulation, it coincides with the institutional value buying on short-term liquidity and long-term value. So in other words, why is it so confusing? Why are we using institutional in both cases? Well, the drop to the downside kind of suggests in the volume signature that institutions are present. They are sellers at this point of time, or rather, I should say, specific institutions are sellers. And then other institutions at the same time are buyers because they are seeing some value, and they are saying that even so early on in the process of establishing the new low, establishing the new accumulation range, we are willing to come in and to buy because there is so many stock shares that are available at this point of time. So they will do exactly that. And this is where we would put that first initial value zone. And then every time we go below that oversold condition, we quickly recover. Go below that oversold condition, quickly recover. Go below, quickly recover. And on the recovery that takes us throughout the whole trading range, that's when we are identifying a major sign of strength, changing of the environment from a trading range to the emergent uptrend thing. And we only need the confirmation by the backing up action. Now look how the price comes back into the value zone, and again that creates what? An oversold condition, but now an oversold relative to the price that is above the value zone. And again, it acts as a spring type of price action where the price goes below the support and then quickly recovers. Why? Well, because somebody sees value and picks it up. Somebody was seeing value here and then seeing more value even lower. And that should kind of trigger your thinking about, actually not there, sorry, here and here. this type of the decline into the value zone and the way how it recovers so quickly, you should be thinking that the volume increase suggested that there is a lot of demand that is coming in. First demand was absorbing the supply, and then the second demand was absorbing whatever was left. And because supply has diminished, the absorption was faster and the price recovered pretty fast. So think about that type of logic. If you are thinking this way, then you might be even coming in into this position here, because you might be thinking that if this is an oversold in the backing up action, this could be the lowest low in that backing up action, which it was. So, and it could create some kind of like maybe apex formation, and this low is going to be the lowest low. So we want to start thinking this way. Okay. All right, so this one is going to be for your home review. Let's do that. All right, so now let's talk about the volume and spread analysis, and we are 10 to 5. Okay, great. I want you right away to concentrate on one idea and one idea only when you're looking at the volume and spread analysis. And you probably have seen it from different sources, different software sources. So the biggest mistake that I see students do with this material is that they see the signal. They could interpret the signal, but they do not look into the context of where this signal occurs. In other words, you need to understand the environment that we are in and then look into the VSA signal and interpret this signal relative to that environment. So let's look at that. And we're going to start with basics. And this comes actually from one of the Hank students, Jerry Blythe. He is an MD, and Jerry has taken Hank's classes many decades ago, and he has created this kind of like a small spreadsheet references to the volume and spread and the way how they behave. So I'm using this first slide just to give the credit to Jerry and also to go through some general considerations about the spread and the volume. So let's look into this. So under the spread, the increase in spread would suggest that there is a little resistance to the price progress. Decrease in spread would say the opposite, some resistance to price progress. And then the average is going to just express the normal trend of price progress. Volume is going to be much more difficult. General considerations. Usually, volume is going to be associated with the force behind the power. So we usually would think about the effort behind it. Volume usually expresses the quality of supply and demand, and we'll talk a lot about this because we will be creating those volume equations with the supply and demand. Increasing volume in general is going to be usually suggesting supply. That's number one in a lot of cases. But then also it will, in some cases, will show the emergence of the demand. And we will just need to be aware in which environments, in which context we're interpreting that signal between the volume and the price. A very heavy volume usually is all about the supply, but sometimes there's going to be an urgency to accumulate, and that's going to be an absorption on the way up on the major sign of strength. And we've seen that. A massive volume signature usually will indicate the climactic action. Decrease in volume signature would always, we'd be thinking about lessening of the force. And then a very light supply signature is going to indicate, and I think I should take this down. This is actually not necessarily correct. Okay, so let's just keep it like this: increasing, heavy, massive, and decreasing. So those are general considerations about the price and the volume. Now let's look at specific scenarios. And I've created this slide for you guys so that you would print it out. And this is when I say print this out, put this in your library, I mean study it, have it in front of you as a reference, so that we would be on the same page. So one of the things here and about the volume and spread analysis that I'm keep repeating is the context. The context is going to be the definition of the environment that we're currently in, right? So the context, uptrend. And we have different scenarios where, let's say, spread is increasing. And then at the same time, we see that the volume signature is increasing on the same bar. So both result is increasing and effort is increasing. How would it look on the volume equation, right? So volume is increasing, demand is increasing probably more than supply. And we would be thinking that with the expansion of the price on the healthy increase of the volume signature, supply might be actually going lower. It's still present, but it's diminishing, and demand is not only present, but it's increasing. So effort is increasing and result is increasing. It's a bullish activity, and we should expect a continuation of the uptrend. Second scenario, this is where a spread is decreasing, and it still happens on the increased volume signature. So what does it mean? We have a decreasing spread, which means a decreasing result, and we have an increasing volume, which shows us an increasing effort to push the price up. So in other words, there is an increased effort to push the price up, and yet it can do so. Why would that happen? Why would there be some kind of stopping of this progress? Well, it only can happen with the emergence of the supply. So we know that supply is increasing, and demand is still winning because this is an up bar. The close of this bar is higher than the previous bar close. So demand is still dominant over supply, but because supply is increasing, it suggests that supply wants to stop the uptrend from going further up. So therefore, short term, we will interpret this as a potential bearish implication, and short term, we might be expecting some kind of reaction out of this area. Third scenario in the advancing markets, spread is decreasing, and with the decreasing spread, we have a decreasing volume signature. So this is an opposite of the volume signature that we had in scenario number 2. So how would we interpret this? Decreasing spread means decreasing result to the upside, and that happens on the decreasing effort. And here we might be thinking that demand is actually decreasing on the decreasing volume signature. And we probably would be correct. There is a lot of increase of the demand on the previous bar, and then after that, the demand is exhausted, and it's not as much as on the previous bar, so it's going to be shown in the volume signature and it's going to be shown in the result, in the spread. With the supply, this is a little bit difficult here for us to say from the volume signature. Our natural inclination is going to be that supply is decreasing as well, which is because the volume is decreasing. And I think that regularly this is what I would go for. But I also could see how supply could stay at the same level, and that also would suggest some kind of bearish behavior. And also supply could slightly increase from the day when let's say we had the day like this where demand is increasing and supply is decreasing. So imagine that the volume signature is even lower. So this could mean that supply also is decreasing. Well, one way or another, what is happening here is that demand is decreasing, and that suggests some kind of vulnerability to a reaction. So it's interesting how in both cases number 2 and 3, we are suggesting that the reaction should come. But yet, there is a subtle difference here. And hopefully, guys, you already know what it is. And that subtle difference is in the emergence of the supply on the volume signature that is increasing. This is more bearish than the scenario where the volume decreases and supply might be decreasing as well with it. Because that would suggest that, yes, demand is exhausted, but at the same time, so there are no selling. In case number 2, demand might be there, but supply is definitely present and it's increasing. So somebody's selling. And that's kind of like that subtle difference between number 2 and number 3. Number 4, increasing spread and decreasing volume signature. So it's different than scenario number 1. How do we interpret this? Increasing result in the uptrend, we're having a big spread to the upside on the decreasing effort. So this decreasing effort suggests a decreasing of a decrease of the demand together with the decrease of the supply. And it's this decrease of the supply that makes it a bullish scenario, because it basically tells us that there is no one selling at this point, and therefore supply is not available, and demand is also decreasing, but there is no need for a lot of demand to push the price up. We would refer to this type of action as an ease of movement, and we'll talk more about this. Ease of movement suggests a progression of the price in the direction of a current trend on decreasing effort, where the opposite force, whether it's a supply or demand, is decreasing as well. Last one, number 5. Spread is increasing, volume is increasing, and it's increasing massively. So there is a massive volume signature, and that represents a massive effort to push the price up. And usually we would see this on the chart as like a big, big volume spike. And we would be talking about the volume spike as the massive increase in volume that suggests that the demand is still there and it's increasing as well. But at the same time, supply is increasing too. It's not only present and it's not only increasing. Relative to the previous examples that we've seen where supply might increase, we are seeing that here an increase of the supply is substantial. And that suggests institutional selling. And with institutional selling, the short-term scenario is always going to be bearish. And usually that's what kind of produces those stopping actions as buying climaxes. This is where a lot of exchange of shares is going to happen. This could be a terminal buying climax. This could be intermediate buying climax. Usually would happen into the overbought, overthrown condition. That's kind of like a preferred scenario. It also could have, we could also see it in the trading range, maybe a climactic type of action into the point of the resistance. And then this could act maybe as an upthrust in that structure. So that's a possibility as well. So let's see if we have any questions on this before we move on. Questions, comments? This should be probably easy to grab as an idea. The only thing here is that I want you to concentrate on is, and obviously I want you to go through this as you go through your homework, I definitely want you to remember these scenarios. All right, so Nilesh is asking, how do open and closed levels impact these interpretations? I think we're going to answer this question, Nilesh, a little bit later on, but this is a good one, so let's keep that in mind. For now, we just want to concentrate on the spread and volume and that relationship. Okay, let's look at the next one. In the declining market, where the context is the downtrend, let's look at all of these scenarios again. They're going to be just a mirror image of the ones that we looked for the advancing market. Spread is increasing, volume is increasing. It's an increasing result with the increasing effort. And when the volume signature is normal, this is just a normal activity in the downtrend action. This is where supply is going to increase and it's going to still dominate over demand. Demand could be very easily decreasing at this point of time. The short-term bias for this interpretation is going to be bearish and a continuation to the downside. Next one, in scenario number 7, decreasing spread and increasing volume signature. So we're seeing that the spread has decreased significantly, and yet the volume signature still is going up. So we have a case of the decreasing result happening on the increasing effort, where supply is still increasing, but we already see some emergence of the demand. And as demand attempts to stop the downtrend, that's the intention. Just because the volume signature is so high, that suggests that this emergence of the demand could stop the trend from going further down. And by the way, when I say that stop the trend, it could be even a temporary stopping. It could produce just a temporary short-term rally and then continue with the downtrend. Or it could produce a more meaningful move to the upside. It's all contextual. We will have to look at where exactly it happens. But for the short-term bias, we're always going to be thinking bullish in this scenario. We would be thinking that demand is there, it's emerging, it's increasing, it's absorbing the supply. So the downtrend is vulnerable at this point of time. The same would happen on the diminishing spread and the diminishing volume signature. We would be thinking that demand is diminishing at this point. Now, the only difference between this and the previous scenario number 7, is that in scenario number 8, supply is decreasing as well. The overall signature, volume signature, is going down. So most likely, we're going to have diminished supply and diminished demand at the same time. Now, that's actually still preferable to the bearish scenario, just because demand is not there. Demand is poor. So even diminishing supply could push the price further down. Okay, and this is where I see the mistake. So this would be, oh no, actually, that's fine. Okay, so next one, number 9, increasing spread and decreasing volume signature. If we would compare it to number 6, that would be a good comparison. I probably need to shift them a little bit here. Okay, so what do we see on the result? Obviously, increasing result with this type of spread, and then it happens on the decreasing effort. Volume signature goes down. So that suggests both decrease of the supply and decrease of the demand. And that suggests, again, an ease of movement, as the price could move lower on diminishing demand signature, and therefore it is a short-term bearish interpretation. Well, I see the mistake right here. It should be bullish here. It should be bearish. Hold on a second. Decreasing result, decreasing effort. Okay, decreasing demand. just a continuation. What did I do on the previous slide? I see. Okay, yeah. I think this is the one that should be bullish. Apologies for that. So vulnerable to rally. So yes, bullish. I was thinking like I'm gonna make a mistake somewhere. So that this is it. Okay, so ease of movement, and then the last one is the climactic one, right? So selling climax with the massive volume signature, massive effort behind it. Supply is increasing a lot because of the panicky selling by weekends, but demand is increasing at a much faster rate than anything that we've seen before on the demand increase. So therefore, we're concluding that this is an institutional demand, and therefore it's bullish. A stop in action, reversal, and attempt to rally. Okay, yeah, thank you, Philip. That's great. I like the fact that you like the slides. Yeah, was trying to make them simple but yet very informative. So these are the slides that I want you guys to print out. Again, you know, in this case right here, let me just correct this maybe right away. So here it's actually bullish. Okay, awesome. All right, guys. So something to think about, study, print those out, go through, because we're going to use those a lot in our group exercise. Speaking of homeworks, so this is the first homework from this class. We are going to look into the volume and spread analysis, and what I want you to do is to visualize all concepts from previous two slides, number 19 and 20, on any of the chart. So take all of these 10 scenarios, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, all of them, and find examples on preferably one chart. I am not expecting you to send me 10 charts for different scenarios. I want you to find maybe like one chart that would contain, if not all of them, then the majority of them, and just send this slide to me or chart and identify all of these 10 scenarios. All right, so that's a homework number one. Now let's talk about the laws of supply and demand and effort versus result. So as you know, Wyckoff method has 3 laws. The first one is the law of supply and demand. And on a very basic level, it just basically says that if you have more demand than supply, then the price will go up. When you have more supply than demand, then the price will fall. And sometimes I think we overcomplicate our volume and price analysis, and we forget about this simple interpretation of the supply and demand and what it means. So I want to point your attention to that. Now, the biggest law for me in the whole methodology is the law of effort versus result. Because effort versus result encompasses both a situation where a supply is larger than demand and the price goes down easily, and when demand is larger than supply and the price goes up easily. But it also suggests a different scenario. It suggests that when we have an increase in effort, an increase and decrease in the result, we are going to have an opposite counter to the general observation of the increased effort conclusion. We will basically say that the price is going to do an opposite thing. And that's what we need to learn. And that's why the law of effort versus result is so important. So how would we measure the effort? Well, obviously, we're going to look at the volume signature, and we're going to say that volume is just the representation of the effort. But we're going to be a little bit more specific about the effort. And to me, effort is either increase or decrease in the volume signature. It's not just the volume signature itself. It's the way with which the volume changes, right? So we usually would say, okay, we see an increased volume signature. That would mean that the effort to push the price down has increased a lot. And what do we see? We see some progression, but we also see some kind of stop in action. That suggests that behind this increase in volume signature, there is some demand signature. And there are some buyers. Because of the extreme volume signature, it's institutional buyers. And actually, we know exactly who was buying Goldman Sachs in 2008 in September. There was some news that came out during that month that Warren Buffett was buying the stock through warrants at a price of 120. Please note that the price went below 60. And he still held on to that position because obviously because of the warrants, I understand that. But the CO type of institutions are thinking in a different way than we do. And our task is obviously to understand how they think and how they behave. So, and this is what we're studying in this course. And you could see from this example, as he's buying, the price goes up, and then it absorbs a lot of available supply at this level. So then the next time the price goes down, supply is going down, and someone else is buying. And then all of the other times, again, supply is going down. So there is absorption process that is underway that has started with, Warren Buffett purchases here. And then whatever he absorbed is no longer available in the market, or whatever, other institutions absorbed at this point of time. And therefore, supply is still going to be relatively high to the averages, but relative to the previous spikes is going to be smaller, just because absorption has happened. So what we want to see from the effort is the increase of the decrease of effort. And then obviously when we're going to have an extreme increase in effort, that's usually going to be associated with gaps, with stopping actions, with momentum type of bars, and so on and so forth. We need to understand how we will judge the result, how we would assess the result. Obviously, result will either increase or decrease as well. So I've developed specific measurements, and those are just for our WTC course. I want us to look into the increase or the decrease of a spread or a true range, and we'll talk about this in the next class. We're also going to look into the close, and we will be thinking about two ways of how to address the close. And the question from Nilesh was previously about how would the close or the closes influence our interpretation of the result. So we will look into the close from two perspectives: relative to the daily spread, or a true range, right? So we would be looking at how do we close relative to the actual height of the spread, right? So if we're closing in the upper part above 1/2 of the spread, we're going to interpret this as bullish. If we're closing below 1/2, we are going to interpret it as bearish close. And then we're also going to look at the closes from the perspective of the previous close. So we're going to look at the previous close, and then we're going to make a judgment as to the next close, and we're going to look at the progression of close to close. Because think about closes as the commitment of institutional traders in the direction of the current swing or current trend. So it's going to be extremely important for us to see what's the progress between one close to another. And then the third one is going to be extremely important, and it's going to be somewhat um, uh, difficult for us to remember that this is something that we will be looking at. It's the intention. And the intention behind the bar is always going to be overcoming some kind of commitment line. It could be a resistance, it could be the previous day bar high. And if we see that commitment above, we're going to say that the intention was fulfilled. If we're going to have a bar that comes close to that, maybe even attempts to commit but then comes back, we're going to say that the intention to commit above the commitment line or the specific resistance line has failed. So therefore, as a result, we're going to say that intention has failed. We're going to say no, and that would mean that the result is diminishing. And that's a very, very important point. Volume spikes. Well, we kind of discussed those in the previous two slides, but still, again, up spike is going to be on the up bar where demand still dominates the supply, but supply is already increasing and it's producing some selling. The down spike is going to be where supply is going to dominate the demand, but demand is already increasing as well, and it's absorbing the supply at that point of time. It's suggesting the stop in action and the reversal. So again, this is something that I want you to remember by heart. What do we look at in the effort? What do we look at in the result? Especially how do we measure the result? That's extremely important. And then I also want you to understand that in some cases, for instance, in the case of this latest reaction, we are going to have an increased volume signature that would suggest or equal an increased downward pressure. Effort to the downside is increasing. And we're going to look at this reaction and we're going to say this reaction is actually not that big. It's actually in line with the previous reaction, and it's less than the reactions that we've seen before at the beginning of the move. So therefore, we're going to say that the result to the downside has decreased. So what's interesting is that here there is an opposite trajectory for effort in the result. The effort is trying to stay up and is trying to increase and to push the price up. So the effort to push the price up increases while the result is somewhat mediocre. And this is where this law of effort versus result is so valuable. That increased effort on the increased volume signature would suggest an inability to push the price down would suggest that something is interfering. Something is stopping the selling from pushing the price further down. What could it be? Only one thing: buying or demand. Well, not just a regular demand, probably institutional demand, just because the volume went up so high and the public cannot have that type of volume signature. And that's why this law is so important. Out of all of the three laws, if you will remember one, remember this one. Remember the effort versus result. Okay, next question. Should the increase or decrease in volume be compared to local volume signature or meet long-term levels as well? Now, Lesh, again, really good questions. I like that. It's just that they're a little bit ahead of where we are. So we'll definitely discuss that during our exercise, and we'll definitely discuss both the more local increase and more long-term increase, and we'll just go through this material. Okay, now the exciting part. Okay, so we are starting our group exercise, and I will need a volunteer at this point. So think about this for a second. Meanwhile, our exercise is going to be devoted to both volume and price analysis and price structural analysis. This is the exercise where we are going to combine the knowledge that we got on the price structure and the new information that I'm going to still keep giving you through all of these 5 classes that we're going to have on volume and price. The assignment for this exercise is to identify what is dominant, supply or demand. And we're going to dissect this either with the single bar analysis or with the swing analysis. We, as I mentioned, going to combine the price structural analysis with volume analysis. I want you to make your call on what kind of most probable price action we will have after a point of discussion on the chart that we're going to look at. I also is going to ask you for labeling of Wyckoff phases and events of any of the trading ranges that you see. And most important task as a homework task is going to be to watch the video of this exercise again, excuse me, and to make some notes. And then I want you to email these notes to me. So that's the assignment for this exercise. Now let's look at the chart. So this chart is going to be presented to you like this. There is no reference to the stock that it is. There is no reference to the time. And I've learned that this is only just a distraction for students when I give this type of information. So, and it came to the point that I even forgot what this stock is. I do not know the name. I do not know the symbol. Please don't ask me. But what I'm really concerned about here with this exercise is the way how we're going to analyze this. This is going to be such a foundational exercise. This is something that I want you to be extremely serious about. I want you to be uncomfortable about this exercise because there will be a lot of concepts that we're going to combine, and at first time it just might, see as kind of like a difficult thing to do. But then something will click and the understanding will come to you. It will emerge in your mind. And that's what we're trying to do with this exercise, to combine the volume and price with the price structure and to start talking about the logic of the analysis, how it flows, how do we analyze it. And because of this logic, I'm trying to create a specific way of how we would be thinking about this analysis. So I want you to think about a bar analysis first, and each bar, not each bar, but each significant bar that I want us to discuss has some kind of number assigned to it. And then after that, and we're going to discuss it from the point of view of the effort and the result, exactly what we went through just now. And then we're going to discuss a swing analysis. So we're going to look at the current swing, so let's say swing number 3, and we're going to discuss, well, relative to this swing, the previous swing to the downside, what characteristics we see, and then the previous counter swing, like this one right here. So we're basically going to compare a swing to a swing. We also will talk about the market behavioral analysis and that is the behavior between strong and weak hands. And we're going to try to define for each type of the market participant what are they doing at that spot. And that will create a better understanding for you as to what is happening right now. And then obviously we need final deductions, or rather inductions. Those are going to be on the bias, on the timing, and on the character. And we'll talk about this more as we go through this exercise. But for now, I want you to do two things. We still have maybe half an hour to go. So I want you to, for a couple of minutes, maybe 2 or 3 minutes, and I'll mute myself and I'll go grab some tea. I want you to look at this chart and to analyze the first, maybe 3 swings, and we'll talk about this, and hopefully we'll be able to cover even more today in this 30 minutes. But if not, then let's just concentrate on the swing number 1, swing number 2, and swing number 3. And secondly, I want you to say yes if you would like to volunteer and to go with me through this analysis. Thirdly, for the homework, this is the type of the structure, analytical structure that I want you to have. And I want you, as you analyze, and the homework is going to be to analyze the rest. I want you to analyze all of the bars and all of the swings. You don't have to do it all at the same time. You could do this at your own pace. I don't know where exactly we're going to stop today. I don't know where we're going to stop next week. So therefore, just go at your own pace and then compare your analysis to the analysis that's going to be presented in the class. And we'll kind of see how that is going to develop. All right, so for now, 2 minutes break for me, tea break. Meanwhile, I want you to think about the analysis of the first, 3 to 5 swings and the analysis of the bars that are being mentioned. And also say yes if you'd like to volunteer. And we'll go from there. Thank you, guys. All right, guys, volunteers. Maybe someone new. And obviously I'm here to help, so we're gonna go through this together. Okay, 1, 2, all right. Okay, Nalesh, how you doing today?
I'm doing good. How are you
Good,
today?
good, good. Yeah, I just feel like my throat hurts a little bit, but um, I had to stop at many spots, guys, today, so I apologize for that. All right, so let's start our analysis, and let's start with bar number one, right here. This seems like a conclusion of swing number one, and let's kind of discuss this bar a little bit. What do we see behind this bar for the result and for the effort?
So the volume is slightly up compared to the earlier close. Uh,
Mhm.
so the effort has increased.
So
Uh,
slightly increased, I would agree. So there's not like a huge effort, right? Because we're seeing it at bar number one as the conclusion of that swing to the downside, right? But there is not a lot of increase. There is some increase in the volume signature that suggests what?
Demand is up
Mhm.
slightly, and supply is also, I would say, still present.
Yeah, supply probably either still present, it could be increasing at the same time. I mean, like this is such a bad reference for us on the volume signature, but you're right, it's at the highest point, of the volume here. We see it here, we see it here, we see it here, slightly here. So it's one of the highest, increases. But relative to what we see afterwards, of course, this is just not relevant that much. So what do you think is dominating as an effort, supply or demand?
I think demand is slightly dominating, just going by the close of this candle.
Yeah, I think so too. Going by the close, this is usually it's going to be our defining factor for dominating effort. So it closes exactly on the close of the previous bar, but the fact that it traveled up so much, and closed out of kind of like a sprint type of situation, right? Where we might be thinking that this is just a trading range right here, and then the price goes below and then it recovers on the same day. So it's sprint type of action. So that suggests, yes, that demand dominates over supply. Okay, so um, what about the result? What is the most kind of like obvious result thing that we see? And I don't think that for this particular bar we're going to go into a lot of the details, but still, uh, you mentioned the close, right?
Mhm.
The close to the spread is in the upper part, so that's bullish. That's increasing. Close to close, kind of the same. The intention, what was the intention for this bar? What do you think?
To stop the downward movement.
Okay, yes. And also overcoming some kind of commitment level. Where's the commitment level for us?
The close of earlier candle, maybe.
Just all of these bars that are touching this line, right? The support line. So support line acts as that commitment line for us, and we're closing above that. So the intention was to go up and to close above the commitment line, which acted as a support, and we did exactly that. So yes, bullish. And it seems that we could say that the effort to the upside increased slightly, and then the result to the upside also increased. Bullish or bearish?
Uh, Bullish.
Bullish. So short-term bullish, and we could expect some kind of rally out of this. Okay, well, the rally happens. It goes into bar number two, and this is where the whole story, starts to unfold around for this area. So let's think about bar number 2 analysis. Okay, so what is happening with effort?
Increased by a huge margin as compared to the earlier ones. Yeah.
Okay, so effort is increased a lot. Volume is increased a lot. Demand. Is demand increasing?
I would say yes, but the supply too is increased.
Okay, so demand has increased. What is the dominating force over
Demand.
effort? Yeah, demand still dominates the supply because the price has moved up, closed up. Okay, great. And then what did you say about the supply? Is supply going up or down?
Up.
Up. More than demand?
No, not more than demand.
Not more than demand, but it's going up. So basically we have volume increase, volume spike, with the supply increase, I'm sorry, with the demand increase, because demand is still dominant, and with the supply increase as well, but it's not as dominant as the demand. But this emergence of the supply suggests that institutions are doing what?
Buying.
Institutions are selling. Why? Well, because we see two things. What happens? In hindsight, we see that the price went down. So they definitely selling into the strength of weak hands buying. And then what would be the second most important identification that supply is of institutional quality? And that's the question for everyone.
I think the signature of is too large to be weak hands or public.
Yeah, we know that. We know that there is an institutional volume signature, right? We're just trying to define institutions as selling on this bar or buying. And by institutions, I obviously mean strong hands. What about, let's go further through the list. What about this spread, the result? Now let's discuss the result.
Spread has gone up.
Okay, so spread has increased tremendously. Okay, so close relative to the whole spread.
Is bullish.
Bullish, because we are closing on this spread in the upper part of the whole spread. Okay, close to close. So
Is again
from this
bullish.
close to this close. Bullish as well?
Yes.
Absolutely. Yeah, nothing to think about here because we are just from close to close. We're traveling the biggest distance than anything that we've seen before, right? So close to close, and so on and so forth. Okay, what about the intention?
Intention was to get to overcome the resistance, but I think it kind of failed because such a huge increase in volume, but it could not overcome the earlier resistance.
Oh my gosh. Yeah, that's exactly where we want to go with this. Look at this resistance level and look at the bar in question. Huge effort. Think about all of this buying power behind this bar. And yet, if the intention was to overcome the level of the resistance that was created by these two highs right here, where do we close? Because we're closing below that level. We just touched that level and then close below it. What does that suggest?
Institutions are selling probably
Yeah,
there's huge supply. Yeah.
yeah, most likely as the price goes into that resistance level, institutions are selling into the strength of weak hands, and that's what producing that stop in action before that resistance and pushes the close below that level of the resistance. So now we know that institutions are selling and the intention was not fulfilled. So even though spread is increasing, close to spread is bullish, close to close is bullish. But because of the intention and how it has failed to materialize, we're going to say that the result is actually diminishing. And therefore, our effort result signature is going to look like this. Up effort is increasing a lot, and then up result is actually failing, diminishing. So how would we interpret this? As a bullish short term or as a bearish short term?
Bearish.
Bearish, yes. So what's happening here is lots of effort to push the price above the commitment level, and yet we cannot do this despite of all of the bullish characteristics of the spread. So therefore, we would be thinking that institutions are selling. And Philip is asking, we always care about the intentions of the CO or the weak hands also. Yeah, we care about different strong and weak hands, right? So we want to understand where all of these market participants are going to come in into the market and how they're going to behave. So from this perspective, bar number 2, we would be thinking that professionals are probably doing mean reversion trade, right? CO is not participating at this point. And then ITFs are not participating in active. And public, Nilesh, what do you think public is doing here?
I think they are participating, they are buying.
Yeah, they are buyers, exactly. So they are buyers on this particular bar. Okay, so the next thing that happens is bar number 3. And bar number 3 acts as a confirmation for the selling pressure that has come on bar number 2. Why is that, Nilesh?
Because it opened and closed, I think, below the earlier close.
Okay, so close and then open. Right away, we see some kind of gap. So that's bearish by itself. Okay. But more importantly, and Dog is asking here, isn't it too early to make that judgment about bar number 2? Wouldn't we just have to wait for the next bar? And usually on a bar like this, Dog would be extremely accurate in stating this because we would be thinking that this is some kind of momentum type of bar, and usually that momentum bar on that type of volume signature is going to have the increase of the supply, and therefore we need some kind of retest. And we want the retest of that type of action to have specific characteristics. We want this spread, which is the down spread, to diminish. We want the supply to diminish as well. And we don't want to see any violation of the open, low, and we see it right here. So what does that suggest, Nilesh? That violation of the low?
Right, right. Sorry, I was on mute. Yeah. That violation of low suggests that it's uh, there is no demand.
Yeah, that the demand that was here on bar number 2, that is hidden on the volume spike, it's of poor quality. And we kind of already identified there is some institutional selling coming in. And then the next day, there is no continuation. So that confirms that whatever supply has come on bar number 2 is of institutional quality, and that we are just continuing with the same buys on bar number 3. There are no more buyers at this point, and there are no more sellers. Bar number 2 combined both of them, the sellers and the buyers, both of the camps. And everything was done on bar number 2. Everybody positions themselves, and bar number 3 is just a test, a resolution bar that just tells us that sellers have won. So therefore, as sellers have won, Nilesh, where do you think the buyers are going to have their stop losses?
Stop loss.
I'm going to suggest a couple of places. How about this one, right? Right below this low, right below this low, and then how about this one right here, right below this low? So, and what's going to happen when the stop losses are going to be hit?
They liquidate and just sell at the market price.
Mhm. So we can't stop, I'm sorry, we can't point of entry that bar, and then we can't stop losses, two levels. So when the price is going to go through, that stop loss is going to become a market order and it's going to be executed, and that's going to be a sale. Therefore, that's going to increase the level of supply, and the volume signature should go up. So look at the first stop loss level. We definitely see that the volume has increased. And look at the bar number 5, which is the second level. So this is where the majority of the stop losses were. And that's why the volume signature increases here on stop losses. They're becoming the market orders, they're being hit, becoming market orders, and there is a capitulation by weak hands. So right away notice what happens afterwards. Bar number 5 is that heating of the stop losses and increase in the volume signature. Nilesh, what does that suggest for the swing to the downside? Continuation?
Yes.
Okay, but bar number 5 is also very interesting. Let's go through bar number 5. The volume definitely has increased. Do we see an increase in supply just because it was the first move was to the downside?
Yes.
So supply has increased. Do we see an increase in demand?
I would say yes. Demand also increase.
Yeah, absolutely. What is dominating as an effort?
Still supply is dominating.
Probably supply still is dominating demand at this point of time. Some demand came in. We see this from the tail, right? So let's quickly go through the result. So the spread is what? Is maybe slightly decreasing relative to spread number 4, or maybe the same. Close is what, Nilesh?
Close is bearish.
It closes in the upper part of the spread. Look at this whole
Oh, okay.
spread.
Yeah. In the context, yeah, it's bullish.
Yeah,
Yeah.
look at 1/2. So yes, a bullish spread. So some counter. Okay, close to close.
Bearish.
Bearish. Closes below. Okay, and then the intention was to overcome what?
The support.
Yeah, some kind of support level. So, and it kind of closes right on this support level. And if you would take some kind of cluster from this support, from this resistance, we still have not really closed even into that cluster, right? So we're going to say no. So that's on the bullish side. So a very interesting picture here where there are some bullish characteristics that fail, and that is happening on still increased level of the supply and increased volume signature and increased effort. So the downward effort has increased a lot, whereas the downward result has suggested some buying, but basically failed as well because the intention was to overcome the point of commitment, the point of resistance, and it just closed on the level of the resistance. It didn't really close significantly above that. So that's still suggest a bearish picture. Am I correct, Naresh?
Right.
And bearish pictures suggest a continuation of a decline, which we do. And then we go into bar number 6. So let's analyze bar number 6. Volume. What is volume doing?
Volume is up, but not less than still for bar number 5. Yeah.
Yeah, this is an interesting picture because bar number 2, bar number 5, and bar number 6, all of them have the same intention. What is that, Nilesh?
Uh, to get the price down, or
To push the price up, right?
sorry, the
No,
price.
not down. Yeah, price up. Yeah. So the bar number 2 is the most successful out of those 3, but again, it doesn't overcome the point of the resistance. Bar number 5 is slightly better on the commitment. It's almost there, but not really. And then, the volume signature goes down. And bar number 6 is not really committing above the resistance that we have there either. But all 3 bars have the same intention. They are trying to push the price up. Now, for us to understand how demand is functioning on those 3 bars, I think we need to talk about the supply first. So what is happening with the supply signature from bar number 2 to bar number 5 to bar number 6?
I think supply is decreasing.
Yeah, supply is decreasing, and supply is decreasing on the way down. So as supply decreasing on the way down, we also see that some demand is emerging, right? And we could say that maybe demand is also decreasing in a way. But yet, let's look at the progress here that we see. If we would take bar number 5 and bar number 6 and compare them. So we're comparing number 5 and comparing number 6. So what could we say about, let's say, the travel of the price from the low to the close?
So it's about the same, I would say.
So from the low to the close, it's somewhat the same. And yet, so this is the result. And yet, what do we see on the effort of the demand? So we're seeing that the demand has diminished from bar number 5 to number 6, right? Do we see that, guys? We're looking at the volume signature and we see that the volume is going down. So that suggests that both supply and demand are diminishing at the same time. Supply is still somewhat dominant, but demand is going down as well, and supply is going down. So the distance then that the bar number 5 and bar number 6 travel from the low to the close happens on diminishing effort to the upside. So the question is this rally from the low to the close on bar number 6 an easier move to the upside than on bar number 5?
Yes.
Do you guys see that? I want some kind of feedback from all of you guys. Just say something. Yes, I see it. Yes. So we're talking about the distance from the low of bar number 5 to the close, and then from the low of bar number 6 to the close. We're saying that from the low to the close on both bar number 5 and 6, we kind of have this similar result. Yet there is a subtle difference in the way how the volume behaves. The volume goes down, which suggests that both supply goes down and demand goes down. So now we're thinking like, okay, the same result for bar number 5 and bar number 6, and yet it happens on diminishing demand signature. So it means what? It means that it's easier to advance the price. And if it's easier to advance the price, we would be thinking about maybe like an ease of movement where demand is diminishing and yet the price is going up. Is it bullish, Nilesh, or bearish?
Bullish.
It's bullish, at least short term. And therefore, we could expect some kind of rally out of this spot. Okay, well, here's the rally. It's to the point number 7. And Nilesh, I think that we're going to stop here.
Sure.
Thank you so much.
Thank you.
I hear young Wyckoffans there on the background. We definitely love that. So okay, so we've discussed it up to bar number 6, swing number 3. So what I want you guys to do is to kind of play around with this. My general assignment here for you is just to go through the whole chart and just to analyze it, bar by bar, swing by swing. Again, you don't have to do everything. Probably in the next class, we're going to stop somewhere here, or maybe here. I don't know exactly where we're going to stop. It all depends on how, the class is going to unfold. So therefore, just go at your own pace. Maybe as a point of reference, let's do everything until point number 25, and that would be fair. I don't want to overwhelm you as well. But I want you to analyze, yes, I want you to analyze all of these bars, all of these swings. I want you to think about the market behavioral analysis. I want you to finally deduct something as to, like at bar number 9, what is happening that, concludes, let's say, this environment and suggests that we're going to go up. I want to hear your reasoning. I want to understand how your mind thinks on this. So, and you will be ready, to discuss all of this, and it's just going to go a little bit faster. You can use this format. Please do so, and you could send me, different slides on, let's say, different bars, different swings, and so on and so forth. But not necessary. You could just show me what you in any other different ways that you want to show how you analyze all of the bars and all of the swings, I would definitely accept that. I'm just giving you maybe an example of how you could do that. All right, and this is going to be the exercise for the next 5 sessions or so. Again, this is a very important exercise. We didn't have a lot of time today, but even those 30 minutes for this exercise, please listen to this again, make your notes, send those to me. So quite a few, homework assignments. Again, I'm not insisting on everybody, going through the homework. So just do it at your own pace, and, prioritize. I would say that the priority is this exercise, obviously. But if you have time to do the volume and spread exercise, do that as well. All right, guys. Good class, a lot of material today. I'm glad that we are kind of like getting on with this exercise. Sorry and apologies that I was not feeling that well today. I think I'm feeling better now by the end of the class, surprisingly. So I'll see you all next week, and have fun with the homework. Thank you, guys, and bye-bye.